So I'm of the view that the Fed is done hiking rates for the time being at 5%. So they're done. So in June, I don't think we're going to see another rate hike. I think the debate really is there enough previous rate hikes, 500 basis points? Do we just need time for that to sink into the economy and ultimately start to work and tighten financial conditions? Or are we falling short of the mark, and do we actually need to do more? And this isn't something that we want to chase, right? Because we all know that Fed rate hikes work with a lag. So if we've hiked 500 basis points, we're not going to see the full effect of that 500 basis points until another several months. It could be 6 months from now, 9 months from now. So there is a risk of overdoing it and trying to hike rates too much to create a significant downturn in the economy just to get inflation under control when enough might have already been done. It's a close call, but my personal view is that there is going to be no rate hike in June, and the Fed's going to try to move to a time-based guidance and keep the policy rate at about 5.25% for the foreseeable future.
It's interesting you talk about that lag, though, and you say you're talking about the lag in the context of, is the Fed overdoing it, or is the Fed not counting on that lag factor? But is the market taking into account that lag factor? Do you think that the assumptions that we're making right now about interest rates, the assumptions we're making particularly about inflation, are they taking into account the lag effect of existing policy?
Yeah, I'd say that the interest rates certainly are. So if we look at forward interest rates, if we look at short-term policy rates, short-term interest rates, even if we look at the U.S. two-year note, U.S. two-year note is almost 100 basis points below the current Fed funds rate. If you look at, say, the SOFR futures, some of the short-dated futures that are out there, they are still pricing in about 100 basis points of rate cuts over the next 12 to 14 months. So I'd say that even though yields have risen in the recent past, that the bond markets are certainly, the entire bond market's trading below in yield is trading below the Fed funds rate. So I'd say that the bond markets are expecting something more of a close to a harder landing than what the Fed is actually telling us. And this is the great debate of our time right now.